Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me is Micheal Sheehy, Chief Compliance Officer of Payoneer, Cleber Martins, Head of Payments Intelligence and Risk Solutions at ACI Worldwide, and Heman Daswani, Principal Consultant at the Payments Group at Temenos. We're here to discuss how financial institutions are utilizing AI and machine learning technology to combat fraud. It is great to have all of you with us. Welcome to Trade Talks, and let's go around the horn quickly. Micheal, let's start with you. Explain to us where you sit within the financial services ecosystem.
Sure. Hi, everyone. As mentioned, my name is Micheal Sheehy. I'm the Chief Compliance Officer at Payoneer. Payoneer is a cross-border payment institution that's regulated all over the world. We typically provide a financial stack for small and medium businesses to move money around the world in a transparent and secure manner.
All right. And Heman, tell us about the work you're doing at Temenos.
Yes, so we are a 30-year-old organization. We provide software solutions across different verticals of banking, not just payments. And we have over 3,000 financial institutions using our software solutions in over 150 countries.
And Cleber, finally, ACI Worldwide.
I'm Cleber Martins from ACI Worldwide. ACI is empowering the financial ecosystem. It's almost 50 years between banks, financial intermediaries, merchants, billers. And I'm the head of Payments Intelligence and Risk Solutions.
And Cleber, when we think about increasing adoption of real-time payments, what are the main fraud prevention difficulties that companies such as yourself are facing, or just in general? What is the industry facing when it relates to that?
So real-time payments growing at over 16% CAGR, by over 16% CAGR, and criminals are definitely taking advantage of this payment method. It's immediate access to cash on the other end of that transaction. So we're about to launch a new report on what we call a scam scope report, which talks about scams. And scams is the biggest problem. So there's something called authorized push payment, which is a scam that leads the consumer to initiate a transaction. And when the consumer initiates the transaction, it bypasses all the controls that were put in place to make sure that's the real consumer accessing an account, for example, right? Or a digital wallet. So this is the biggest challenge. The growth on APP scams is about 8% year over year, but over real-time payments, the growth is 12% actually. So it's an accelerated growth over those channels. The biggest challenge for the industry is that they don't have visibility to the whole scheme. So the criminal is seeing where the money is leaving. They have control of that person initiating the transaction, and they have access and control to the account where the money is landing. But the two institutions on the two ends, they're limited to their own field. That's their biggest challenge today.
Yeah. And Micheal, given that Payoneer is known for cross-border payment solutions, are there different financial crime risks that are associated with, let's call it domestic payments versus cross-border solutions?
Yes, absolutely. I've built an entire career around helping companies navigate the risks and complexities of a cross-border payment. Inherently, yes, cross-border payments are, much higher risk. I think double-clicking and looking at domestic payments from a regulatory point of view, there's a much more robust framework in place that really outlines what the rights of the consumer is and what the obligations of the financial institution is, so that if something goes wrong, the consumer understands how to get their money back, the bank knows what it needs to do. And also there's a very clear framework in place that if that doesn't go right, the consumer can make a formal complaint to a regulator. When you move over to the cross-border side, this isn't always as crisp, right? There's obviously the inherent risks of moving money around the world, various AML typologies and things like that, but breaking the risks down into the risks to the financial institution and the risks to the customer. The risks to the customer are really the complete opposite of everything I just described in domestic payments. If something goes wrong, is it the sending institution, the receiving institution, the correspondent? Like, it's hard for consumers to track and trace money. They may use payment methods like wires, which it's near impossible to locate and retrieve funds. Moving over to the financial institution, the risks there is, the core risk on cross-border is your correspondent network. You need to ensure that you have a robust framework in place to identify banks and correspondents that you want to work with, ensuring that they have, robust compliance processes and programs in place, that they're adequately funded so that they can provide the safety and security of your customers' money as it moves around the world. Taking all of that, plus the global complexities of multiple currencies, correspondent networks, local payment methods, the risk is much higher on the cross-border side than on the domestic side.
Yeah. So, Heman, that's a perfect segue for the question I have for you. What lessons can be drawn from the implementation of real-time payments in other markets, particularly in balancing speed and security?
Right. So there are a number of lessons that we can learn from various different geographies. Like I'm always on the road talking to various different prospects and clients, financial institutions. And first lesson that from a bank's perspective is that the entire ecosystem of the technology surrounding the payments processing solutions have to modernize or become faster. A lot of the times, the banks are of the view that if they just replace their main payment processing solution with a brand new, shiny new toy, things will be a lot smoother as far as instant payments are concerned. But that's not true, because if you think about the end-to-end life cycle of a payment, it ends in like a few seconds. So your fraud system, your sanction screening system, and even your core has to become a lot more faster to cater to these new requirements of instant payments while ensuring safety. So just like it takes a village to raise a child, we always say that it takes an ecosystem to make an instant payment happen. The other thing that we can learn from various different geographies is about the adoption. The adoption of instant payments generally begins with small dollar P2P transaction use cases, but very quickly it evolves into other scenarios such as P2B transactions, which is a prime example of which is bill payments. And then it spills over to other scenarios such as B2P payments, where the prime example that is evolving in the US is earned wage access. But as the adoption of these instant payments and these use cases evolve or increases, it leads to increased fraud rates, just like was mentioned earlier in the conversation, specifically the APP fraud. And now that it has happened time and time again in different geographies, I think US regulators, US consumers, and US banks can be better prepared to handle these things as they come down the pipe.
Yep. And we're going to get into regulation in just a moment here. But Cleber, I think part of the challenge is this chicken and the egg scenario, because good actors and bad actors are essentially leveraging the same type of technology. So what are new and emerging AI tools are the bad actors using, and how can the payments industry help financial institutions detect and prevent that fraud?
Well, so from the bad actor perspective, one of the most efficient ways to do social engineering is to leverage inherited trust. Meaning that, if the person can convince me that who is talking to me is my father or, a close colleague, it's more likely that I will be doing what, they need me to do. So they're using AI technology to really get to that, right? To get people to initiate those transactions that they should not be initiating. And those scams are all around. From an AI technology perspective, the banks are also using similar technology, not to interact with the customer the same way, but to understand how the customer is feeling as if they're initiating a transaction. There's always a sense of urge that the criminal will use to get the consumer to bypass all their controls on their own head, suspecting that type of activity that they are initiating. From a financial industry perspective, there's new AI technology being developed. We've been working with the ability to do what we call federated machine learning, which is getting AI to learn across the ecosystem other than relying on the data has to be moved all together to a central location. And that's to overcome one of the biggest challenges for AI, because AI definitely learns from the data, but not necessarily the data has to move from where it is originally sitting in order to enable the learning. So with this new technology, we should empower institutions to work collaboratively with AI without having to ever expose their data. That also bypass many of those other constraints, all the idea that PI information is moving around, all of that cost that comes with data normalization. So this new technology is the future where institutions should be able to learn together and then work together without having to expose their data in order to see more than the criminal can see themselves, right?
Yeah. And Michael, I feel like when we are talking about emerging technologies, regardless of what industry it is, it always comes back to the framework, right? So how can regulation and regulatory compliance strategies be improved to prevent financial crime as regulation is evolving with this newer technology? Oh, you're on mute.
Apologies. I think the easiest way to answer that question is to break it down into three pillars. There's the compliance program itself, the technology that supports it, and the regulatory environment in which it operates in. Like going back to the first one, the compliance program, back to basics, it's important that you have a robust, agile compliance program that can move quickly and make changes as new risks or new typologies are exposed. You don't want to be bedded down with slow-moving technology or slow governance processes around it. I think the most important thing for me as the Chief Compliance Officer is what I keep referring to as self-awareness, which is ensuring that you have robust mechanisms in place to detect failures or controls that are not working as effectively and efficiently as possible, and correcting those and adjusting those at pace to ensure that those small problems don't become bigger problems down the line. This is obviously underpinned and supported by a lot of technology. Cleber has been talking about AI. This has been a huge advancement in this space for compliance. At Payoneer, we implemented a level of AI over our transaction monitoring system, which has been incredibly beneficial for us to enable us to detect much more complicated patterns as money moves around the world and really adjust our controls in a meaningful way to mitigate this exposure to us. And then the third bucket or the third pillar would be the regulatory environment itself. Regulators need to move at pace. They need to ensure that the regulations that they're putting into the market are fit for purpose, that the requirements are easy for people to understand. There's been a lot of trends in this space. I think the most recent from a US perspective would have been the AML Act of 2020, which really focused on information sharing between public and private partnerships. Information sharing is a fundamental element of any anti-AML program, to ensure that law enforcement and financial institutions can move at pace. And I expect to see more and more regulation pass globally in relation to this trend.
Yeah, and Heman, I want to talk about regulation in the UK for a moment. It's interesting because you're seeing regulation come out that's shifting towards shared liability between banks and customers. So what are the objections that you're hearing about the shared liability model, and how are banks adapting to ensure stronger fraud prevention? Because it's going to be a brand reputation at some point, especially if that shift is shared between the bank and customers.
Right. So piggybacking off of what Michael said, I think UK is a perfect example of regulatory environment moving at pace and coming up with changes that are applicable or required given the market trends. So yes, UK has been at the forefront of changing regulations to protect fraud victims. Since they were one of the first few countries to adopt instant payments, they have always been at the forefront with these regulatory changes. And even before this shared liability, they had come up with this mandatory offering of confirmation of payee, where the sender of the payment gets to know exactly who they are sending the money to, kind of like an indicator or self-check for themselves to ensure that is it the right person that they want to send the money to. Just a couple of days ago, they went ahead with enforcement of the shared liability principle or shared liability policy. And essentially what that does is that it puts the banks on hook for paying back the victims of the fraud. If we think about it, until now, the fraud losses were generally borne by either the victim himself or herself or his or her bank. The receiving bank was never in the game as far as fraud losses were concerned. And if we think about it even more, the receiving bank is where the fraud or the bad actor has a relationship with. So amongst all these three parties, the sender, the receiver, the sender, the sending bank, and the receiving bank probably has the most information about this bad actor to profile them, understand their activities, and detect any potential fraud. So this shared liability brings the receiving bank also under the purview of sharing the losses for any kind of fraud payouts that need to be done to the victim. And now that they are also in the hook for making these or incurring these fraud losses, the expectation is that the banks, both the sending bank and the receiving bank, will up their game in detection and prevention of the fraud. This is, I feel, a very good step or a significant step in the right direction, but it's not perfect. And there are various kind of shortcomings. First of all, if we say that the banks are always going to pay out to the victim, then we'll see emergence of different type of fraud where the bad actors can collude amongst themselves and pretend to be the victim, knowing that they will be paid out by the banks. The other thing is that the time frame allowed for the banks to do this payout is 5 days, which is questionable. In 5 days, will the bank be actually able to investigate the case and figure out who was at fault in that specific scenario? So there are questions about whether this time is sufficient for the banks to complete their investigation. And the last point is actually very interesting, again, from the bank's perspective. If we think about it, a significant percentage of this APP fraud originates from digital channels. For instance, somebody looking at a marketplace advertisement and starting to go ahead and initiate a transaction from that point. So the question the banks are asking, why are these digital platforms like social media platforms off the hook? Why are they not party in incurring these fraud losses, because they are the ones that are enabling their customers to proliferate these scams and fraud over their platform. So I'll stop here. It's an interesting topic that has its own pros and cons, but I still feel it's a big step in the right direction.
Yeah,
Sorry, if I may jump in on that, Jill, and I'm sorry, this is such an important point, right? That, what UK is doing is creating accountability across the ecosystem. The consumer is always the weakest point, and they are under attack. So creating accountability for, whoever has the power to take an action and do something is an important step. And I think other countries are taking this as a reference, as an example, right? And taking action on that perspective as well. But as much as, there is a fight with the social medias and marketplace, this type of activity will lead those players to start investing in the right technology in order to be more effective. And that's important. That's really important.
And that's exactly, I was going to make essentially the same comment as you. I think it's an interesting model for sure, Heman. And I do agree with Cleber that it does insinuate some accountability on the customer side, but I also think it's forward-looking by recognizing that fraudsters are always going to try and think about a step ahead of how to, play the victim game themselves.
That's
so
right.
Cleber, back to the technology role, right? When you think about predictive technologies such as AI, how can financial institutions utilize AI and machine learning technology to combat this fraud?
So I think I already mentioned earlier, right? They need to work together, first point. And I think they're not working together at this time, right? That's the most important step that will accelerate technology, really help them solving for that problem or mitigating that problem. Very honestly, at the moment that, one institution is trying to use fraud as a competitive differentiator, they're not helping the consumers, and consumers are across the ecosystem. It's the same consumer at a merchant that's struggling with that, it's the same consumer that is in a bank doing investment, another bank doing savings, and a third bank doing, some other financial activity. So it is important that they start investing in technology that enable that collaboration to happen in real time. And once you mention predictive, here's the main point about predictability, right? AI is a tool that can scale and deliver results, but it needs to be precise. If you're using AI in real time, it has to be super precise, because the risk of impacting good customers because you're trying to stop those bad actors might be way more expensive than actually the financial crime itself, right? So at the moment that they start working together and they deliver the right level of precision, they should be able to let AI do what AI does best, which is learn what those patterns as those patterns change. And then the criminals will be challenged to actually come up with something new that AI is not catching, right? And that's the power of a community working together. Michael made a point earlier about, the whole idea of compliance and governance. Imagine a world where AI is actually making decisions in real time, whether a transaction should go through or not, for risk purpose or for even other reasonings. You need to trust that AI solution. That AI solution is driving your business. It can actually stop a whole bank. And then you see, organizations or government organizations stepping in and saying, the financial ecosystem is so important that we need to make sure there's properly controls on the systems that are running our economy, right? And then you see, governance around the type of models, governance around not having bias on those machine learning models. So it's all about precision. It's all about making sure that you have the latest and most advanced technology in hand, and that you're using it properly, but as a community more than individually.
Right. Certainly you can't operate in silos, that's for sure. So, Michael, to wrap up here, how can cross-border payment companies navigate the complexity of regulatory frameworks? One, the financial services ecosystem is heavily regulated. There's multiple jurisdictions, even within the US itself. Now, put on top of that all the other jurisdictions around the world, people, different data privacy laws and so forth. They view data and risk in different ways. So in the absence of something that's 100% cohesive, how are you navigating that across multiple territories and jurisdictions?
Yes, this is something I deal with on a daily basis at Payoneer. We operate in over 190 countries and territories around the world. It requires significant investment and significant amounts of money for us to build out these compliance processes to meet the local and regulatory needs of all of the markets in which we serve. To Cleber's point earlier around AI detecting various amounts of fraud, when those alerts come up, you need to be able to you need to have in place global processes that accommodate like all of those regional nuances to enable you to operate at scale and pace. For us, and the biggest investment that we make is trying to understand those local requirements is really hard from the head office here in New York. We make a significant investment and we build and hire people locally in all of the markets where we're regulated so that they are our subject matter experts. They can transpose the regulation into requirements that our technology teams located around the world can implement and build, and then our compliance processes kick over to ensure that we have that self-awareness in place, that we're testing what we've built to make sure it's actually meeting the fundamental requirements of the regulations. Having those local teams also enables us to build out local relationships with regulators. We can ask them questions. We can truly get to the spirit and understanding of the regulation to make sure that we're meeting the expectation put upon us at all times.
All right. Appreciate everyone's insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.